All right, hello, I'm Joe Dragoni, and this is my Session 6 assignment doing the portfolio risk and return analysis today. So, going through this assignment, our mission today is that we have our first job and want to invest $10,000, our $10,000 signing bonus. Our colleagues suggest going all in on Tesla because it's the future, but our parents say stick with an S&P 500 index fund, but we want to build our own portfolio here. So, available investments with 5-year hypothetical historical data. We have Tesla, Apple, Johnson & Johnson, ExxonMobil, Vanguard Bond, and the S&P 500 fund. So you can see the average returns here, the first percentage points, 35, 22, 9, 8, 3, and 12 respectively. Then the standard deviation being 60, 28, 15, 25, 4, and 18 respectively. And then some correlations to consider. Tesla and Apple correlation is 0.65. Johnson & Johnson and ExxonMobil is 0.3. Tesla and Johnson & Johnson is negative 0.1. And stocks and bonds, negative 0.2. So being the S&P and Vanguard. So going to our first stage in the driver framework, our define and discover stage. Our investment goal here is to build a portfolio to maximize long-term earnings and capital. We want to minimize risk, beat inflation, get a real return. Went over the details already there. And then we're going to go over a 10-year analysis or investing and seeing the returns and the risk for 10 years. Some of the metrics to look at, the annual return, the average return, the Sharpe ratio, which is the return on investment. If the return on the investment is worth the risk taken, a high ratio for that is better. Then the volatility and the volatility being similar to risk. The correlations between all the stocks, we'll see that in a correlation matrix in a second, and then just the risk return ratios. And then some other things to be concerned about or to think about in terms of risks, the balance between volatility and growth, not being too conservative because obviously we want to earn more over the course of our 10 years investing, but we also don't want to be too risky because we don't want to lose our money. And then other events like a recession, a pandemic, or an economic shutdown could play a role here, as like we've had in the past 5 years, since we just looked at 5-year historical data. And those were sprinkled with COVID, government shutdowns, recessions, all of that, and that definitely played a role in the stock market. And then we want to make a plan, not divert from it, do anything behavioral to affect our risk or our returns. So for the represent stage, creating some visualizations for risk, return, volatility, and correlations here. So some other things to consider. A high return is better because we obviously want to earn more money. So we won't say no to a lower return, or we won't say no to a higher return, rather. We will say no to a lower return. Then the higher standard deviation is more volatility and risk. And we want to balance these things out to get our highest return, but not be too conservative like we said already. So just going through some of the code here. We defined our assets and our benchmark, the Tesla, Apple, Johnson & Johnson, ExxonMobil, the Vanguard Bond, and our S&P 500. We got some of our asset data here and our benchmark data. And then we combined all of that in an array to make it easier to look at all the returns and all the standard deviations, to plot. Going through here, create a matrix, the correlations, stock bond correlations here in this line of code. Some assumptions for missing data, some of the correlations that we weren't given, and then a heat map for our correlations, which I'll show in a second, bar chart for the volatility and risk, the risk bar chart here, which we'll see in a second, the average return bar chart, so all of these using Python pandas to make these, and then simulating returns over a 10-year period. As you can see here with our starting investment at $10,000 to create another plot that you'll see in a second. And then our next step, step 5, is visualizing the risk return trade-off using the efficient frontier curve, which we do here. We have all these, a lot of portfolios, just so we can see the curve, the risk-free rate being 2%, and then our correlation matrix plays a role in that as well. And then all this code, even though I'm still pretty new with Python, so I don't know exactly what it does, but we can run this code real quick. I know I went through that a little bit fast, but all it does here is just create our correlation matrix, which you can see here between the 5 stocks, not including our benchmark, which you'll see. We'll make another one with the benchmark in a second, but just with the 5 stocks in the bond, we can see that the highest correlation is with Tesla and Apple being 0.65, ignoring the diagonal because that's just all of the stocks going against each other. So Apple to Apple correlation obviously will be 1 because it's the same. And then the rest of them are pretty in the middle, positive, and then we get some negatives here. All of the stocks with the bond are negative because when stocks go down, bonds go up. Then we also have the annual volatility and risk. Tesla has the highest risk, so our colleagues suggesting putting it all in Tesla would be very risky, as we can see here with the standard deviation rather being the highest for this one. And then bonds are the safest here, as they have the lowest standard deviation. Then our highest annual return, Tesla also has the highest average return annually. So with risk comes return and vice versa, as we can see here. The bonds with the lowest return, they also have the lowest risk, so it's the safest, but you won't earn as much. So that's just being conservative. And then the growth over 10 years plotted in this curve here, this line plot with all of the investment choices we had. So it shows Tesla has the highest growth, but as we can see here, it goes up and down, which just highlights the risk that we'll face. And then ExxonMobil grows as well, but also drops at the end, so it's a little bit risky. As you can see here, it was the 3rd most risky, with Apple being the 2nd, and that's in the orange here, but it doesn't grow as much. And then the S&P 500 also grows, but declines over around year 6. And then the one that grows the least is the bonds. It just grows at a constant rate. And Johnson & Johnson, the green one here, as you can see, I'll scroll down a little so we can see this better, does not grow as much as the rest. And then here's our first efficient frontier curve showing going all in Tesla, and just put the all in Tesla, and the individual asset for Tesla is up here at the very top, highlighting the greatest risk and greatest return here, and the bond showing the least amount of risk and least return here. And this star is our max Sharpe ratio performance between just the 5, not including portfolios being a mix of all of them. It's just like individual here. So our max Sharpe ratio performer would be down here where this red star is, which shows not a lot of return, but not a lot of risk. So now going down to the implementation stage to actually calculate some portfolios here. So I used Y-Finance, Datetime, Matplotlib, as well as NumPy, Pandas, and Seaborn here. So looking through here, we're actually acquiring and validating our data in this first step, as we did in the example in class. And then here in stage 2 is where we calculate our annual returns for all of the stocks. And that includes the correlation matrix again, this time with the S&P 500. And we show that as a heat map again, which we'll see in a second. And then here, that was stage 3 actually, was the risk analysis. And then this was the annual returns, calculating all of the annual returns here. And then we go down to stage 4 to test a bunch of portfolio combinations, which we'll put in another efficient frontier curve here in a second. But we have all of these assets here. And then we do what we called Google Gemini helped calculate a Monte Carlo simulation, which I learned was using a lot of random experiments to just gather a whole bunch of data. So as you can see here, we have 30,000 portfolios, and we're calculating a whole bunch to really see which one the best is. So running down here, it calculates the Monte Carlo simulation and helps to find both the most return, the best Sharpe ratio, the weights for that, how much of each stock we invested per that portfolio, and then showing the volatility as well. And then some more custom portfolios that we made, which included the benchmark, the growth focused equal weights, being 20% for each, growth focused 80% in the tech, which would be more in Tesla and Apple, and then conservative, putting more into the bonds and some of the less riskier stocks as well, and less into Tesla and Apple. So doing all this, putting that all together in another for loop to calculate the return, the risk, and the Sharpe ratio, so we can compare that as well. And then our next stage, stage 5, is where we identify the best portfolio and compare. So we find that we use this line of code to find the max Sharpe ratio, which would be the highest return per the risk, and then the safest, the min volatility portfolio, calculating the one with the lowest risk. And then with the one that we found for the max Sharpe ratio, it'll show us the return, the volatility, the Sharpe ratio, and the weights of each stock that we invested in here. And then same with that minimum volatility. And then this just calculates all of the visualizations, or more visualizations, updated ones, including the efficient frontier curve. And then as well as plotting the custom portfolios, the tech savvy one, the conservative, and the equal weights as well. And then down here, also the all-in on the S&P 500, the benchmark, and all-in on Tesla, which is another thing that we wanted to consider per the description of this problem. So running this, it'll go through. It takes a little bit to run it, although I ran it already, so I know it works. Go up to the top here. This code right here is showing Apple, the bond, the Johnson & Johnson, S&P 500, Tesla, and ExxonMobil for the last 5 days of 2025. So it's actually the real-time data showing the actual results and what the prices were at the given moment that I ran this code. So $262 for Apple, $74 for the certain Vanguard bond that we picked, the S&P 500 being at 671, so on and so forth. And then the average annual returns calculated above in the code for each one, Apple being 21%, Tesla 41%, so that one would be the highest return. But like we said, we did the same thing with the risk as well down here, and Tesla has the highest risk as well. And the bond has the lowest return with the lowest risk. So another way to visualize the causality between the risk and the return here. And then you can also see the other returns in the percentage points. And then we calculated another correlation matrix, this time including the S&P 500 data. So again, showing that here all the bonds put against each other have a correlation of 1, and the highest correlation of stocks being the S&P 500 and Apple, showing that as the S&P 500 goes up, Apple, I guess being in there, also goes up. And then Tesla and Apple have a moderate positive relationship. The S&P 500 and Tesla also have a pretty moderate positive relationship. But again, putting the bonds, correlating those with the rest of the stocks, we can see it's very low. It is a little positive. It's not negative this time, except for with ExxonMobil, showing that when the bonds go up, the ExxonMobil is likely going down. And same with Tesla and Johnson & Johnson, which is another interesting thing to look at here. Going down to the rest of the results from the implement stage, so looking at the return volatility and the Sharpe ratio for the equal weight portfolio here, we can see the weights are all equal. We put 20% of our 10,000 in each of these, so it would be $2,000 in each of these bonds. It doesn't have a very high Sharpe ratio. It's still good. Being the one range is pretty good. It's not risky, so it shows that when we diversify our portfolio, we have less risk and a higher return here. And then when we put more of our bonds in Tesla and Apple, which have more risk, it shows that our volatility here is less than our return. And then our Sharpe ratio is not as good. So this might not be the best option to pick. And then same thing here, the 75% value in bonds. So putting more of our money in bonds, and then ExxonMobil and Johnson & Johnson, the stocks with the less risk, gives us a high return than it does risk, but still lower numbers for the return than the equal weight and growth focused portfolios that we looked at as well. So it does have a good Sharpe ratio, or at least better than the equal weight ratio, but only by 0.07 points. So still maybe not the best our most ideal or optimal portfolio to invest in. Now, the one with our best Sharpe ratio that we found, at least in this example, from what Google Gemini's code has showed me, was the optimal weights here, as you can see here, putting most of our money in ExxonMobil, only a little bit in the bonds, and a little bit in Apple and Tesla, gives us a return of 25.24%, lower risk 18.58%, and then a Sharpe ratio of 1.25, which is still in the good realm. It's nothing spectacular per my research, but this would be our max Sharpe ratio portfolio that the code has calculated here through the Monte Carlo experiment. And then the one with the least amount of volatility here shows the volatility of 6.26%, but trying to be safer and going for the lowest risk gives us less of a return. So that's just the trade-off we have to think about. And the Sharpe ratio here is also not great. So even though we're trying to be safe here, it still will not return us the best amounts. And then the next thing, another efficient frontier curve shows us here the max Sharpe ratio portfolio has a risk of about 0.2 here and a return of 0.25. So it would be right here in this realm, and it is on the outside of the curve and not in the inside. Because as you go down the curve, inside of the curve, it just shows that there are better opportunities as you go out. Then as you can see up here, this gray X, all in Tesla, the greatest amount of volatility, but also the greatest return. And then the growth focused here in this teal rhombus, the minimum volatility portfolio all the way down to the bottom here, as you can see, very low on the return and the risk, and so on and so forth. You can pause the video to analyze this a little bit more. I can show that, but this is the next efficient frontier curve to really analyze all the different portfolios that we came up with. And then now going down to the validation stage, what I did to validate the portfolio is I put what we calculated up here against the benchmark, putting all of our money in the S&P. As you can see here, that's what we did here. And then another benchmark to look at was the 60-40 portfolio, where we put 60% in the S&P 500 and 40% in bonds. And then did the consolidation of all of our data here to return what portfolio it was, the return it gave us, the risk or volatility, and the Sharpe ratio as well. And then had to format a table here so we could see the code. So if I run this for the validation stage, we can see this has rankings for it ranks by the Sharpe ratio. So you can see the highest Sharpe ratio is the max Sharpe ratio portfolio that we calculated here, then it's followed up by the conservative portfolio, putting all of our money in ExxonMobil, and then the one with the worst Sharpe ratio, which is negative, was putting all of our money in bonds, which gives us very little return and still a little bit risky. So what we wouldn't want to do is put all of our money in bonds here. And then what our colleague said about going all in on Tesla, we get the highest return from doing that at 41.77%, but it is also by far the riskiest investment, as it is about almost 30 more than the growth focused, putting most of our money in Tesla and Apple. The risk is 61.34% there. So this is how I validated my answers. And then going down to the evolve stage, evolving what we learned beyond what we learned already. Some of how changing the mix affects the risk and return here. We already saw a little bit of how the different combinations affected risk and return. Putting all of our money in risky stocks like Tesla and Apple gives us a higher return for sure, but the risk is something we want to look at. And then some other applications we can evolve this to include adding other assets to the growth focused portfolio, which likely decreased risk more than decreased return, because as we diversify our portfolio, it becomes less risky. There's less of a worry of putting all of our money in one stock and then that one stock dropping and losing all of our money. And then diversification, like we already said, that's very critical. All of our stocks all in on stocks had the highest risk, even though having some of the highest return numbers, and the efficient frontier curve showing the trade-offs between risk and reward with like we showed above. As you go out on the curve, it gets more optimal for our return. So that's a great visualization to look at. So looking at what the correlations between stocks meant and how that was powerful in diversifying, we saw the bonds having a negative correlation to stocks, meaning that when stocks went down, the bonds tended to go up. And the S&P 500 is already diversified across 500 stocks, as a lot of people know. So that has decent low risk, but when that goes up, it shows that all stocks are moving together, which shows that all the ones within the S&P 500 have a high correlation. And some other things that we could consider might be it not being the best idea to have historical data from the previous 5 years, because as we know, COVID happened back in 2020. We've had a recession, some shutdowns. So that might not happen in the future, or it might happen even worse in the future. So using historical data might not be the best for calculating returns, but might be better for calculating risk. There could be some other new stocks companies that could grow and cause some of the other companies to become obsolete, like maybe Tesla, maybe electrification for cars might become obsolete, and hydrogen power becomes something. So maybe the first brand to absolutely nail on the head hydrogen power might become the next big stock, and Tesla stock might plummet. You never know. Then some other risk measures that I helped or learned some more about through Google Gemini included the Sortino ratio, which is a modification of the Sharpe ratio that only penalizes downside volatility. Value at risk being the 95th percentile of losses, showing what we can expect to lose in a day or a month or any other certain time period fixed, maybe like a week, maybe a year. We can calculate with the value at risk. And then the conditional value at risk would be the average loss on a bad day. Like it would answer the question, if we're having a terrible day, what could we expect to lose on that day? And then last but not least, moving down to the reflection stage, some surprises and some things to take away from this that I got. I learned it really nailed on the head that diversification can reduce risk below individual asset risks. So when you diversify all your money across a bunch of assets, it is a lot less risky than putting all your money in one stock. Because like you said, like we said already, if we invest all of our money in Tesla, if Tesla was to plummet, then we would lose all of our money. But if we have a bunch of money in a lot of different things, then we don't have to worry about that. High return assets generally require accepting higher risk, and portfolio optimization finds the best risk-return combination. So we were able to do that with Google Gemini, and that was a very useful tool to have. But I'm sure there are some more accurate ones out there, but just using Gemini was a good way to begin there. Some surprises that I found included that the importance of risk and return balance. In order to have a high return, you must consider higher risk, and if that's something worth doing, but definitely to diversify your portfolio there. And going on top of diversification again, all of the benefits it has, including more return for less risk, the Sharpe ratio. When you diversify your portfolio, it'll likely increase your Sharpe ratio. And we saw here that not one thing has a causal relationship on every stock. The max Sharpe ratio portfolio might be a bit conservative, even though one may think it might be more diverse or taking more risk. And then another just important general concept in investing in the stock market is that there's not one size that fits all, and there isn't a right answer for everyone. And there might be a different risk tolerance between a young investor and a retiree. Maybe the retiree wants less risk and just wants like steady income since they're not working, but the young investor getting more money might want to be ambitious and grow, take a risk because they still have all this time to turn their life around, say if they lose all their money in betting all on Tesla. And then so past performance is not indicative of future results. Returns are not stable, correlations are susceptible to change, and the world is also changing. There's not always pandemics, recessions, economic shutdowns, and there are always new companies growing or old companies, losing money, becoming obsolete, as we already talked about. So we can't just rely on the same stocks or just past performance of the same stocks over and over again. And then just from that, like we talked about already with that historical data, it might be better for modeling future risk rather than modeling future returns because things are always changing. So that was my session 6 assignment. Thank you for watching.